Jack, thanks for speaking with us.
Always my treat. Thank you.
One of the striking things that I heard you say at one of my first meetings was that you could teach just about everything about investing in just a few minutes. If I were to put you in front of every single person in the country for those few minutes, what would you say to them?
Well, I'd say first, invest you must. If you don't put money away, you'll end up with nothing. Pretty clear. How to invest? Don't make it any more complicated than it is. Own the stock market and own the bond market. And you can own the stock market through an all-market index fund. You can own the bond market through an all-bond market index fund. And that's the most sensible way to invest. And you have to figure out kind of for yourself. If you're young, you want to be very heavily towards stocks. If you're old and you've got more wealth, less appetite for risk, need income more, you want to tilt heavily to bonds. It's a lifetime asset allocation struggle. And just make sure the funds you buy are low cost. Don't pay sales loads. Watch out for funds that have high turnovers. Index funds do not. Make sure you have very, very low cost operating costs and zero management cost, which you do in an index fund. And then be careful of tax efficiency, because trading is very expensive. You pay taxes, and that devastates long-term investment returns. So it's the bond market and the stock market, and get costs out of the equation. And I guess my final piece of advice would be, don't peak. Just put your money away month after month after month after month, and don't look. And if you start when you're 20 and retire when you're 80, which I'm thinking about doing but haven't decided to do it yet, and you see what that account is worth in 60 years, you aren't going to believe it. Throw everything else out along the way.
That sounds like fantastic advice. So when you're tempted to peak, or even worse, when you're tempted to do something in response to everything else that's going on, what should we do? How do we avoid that? Well,
this great sort of American ethic that we can always win, and the great statement is, don't just stand there, do something. And my advice is, don't do something, just stand there. Because we get most excited and most depressed and most likely to sell when the market's at a low. And we get most elated and most optimistic when the market's at a high. When the market's at a low, you're tempted therefore to sell. When the market's at a high, you're tempted to buy. So don't try and time the market. I've often said that I don't know how to time the market. I don't know anybody who has ever been able to time the market successfully. And I don't even know anybody who knows anybody that's timed the market successfully. That's a lot of people.
The Prussian general Clausewitz has said, "The greatest enemy of a good plan is a dream of a perfect plan." In search of the perfect portfolio with perfect investments, we often overcomplicate our investing and personal finance strategy. If you search the web, there are literally endless lists of portfolio ideas that all espouse why one is better than the other. However, one thing they all have in common is that they're more complicated than the simplest portfolio I'm going to cover in this video. Simplicity is one of the most overlooked and underrated vocabulary in the American dictionary. We subconsciously doubt when an answer to a complex problem seems so simple. And this is especially so true when it comes to investing. The financial media has done a great job of making it seem like investing should be complex and difficult. It's created an illusion that if we're to do more work, more research, and do more digging, we'll find the secret elixir of a perfect investment portfolio that will make us millions. However, the brutal truth is this. The more complex an investment is, the less likely it is to be profitable. And to pop the bubble even more, there is no such a thing as a perfect plan. Only a plan that works and works for you. This is where I want to introduce to you the simplest investment portfolio in the world. 2 simple index funds and a checking account. Let's dig more into the specific tools. Number 1 tool is an equities fund. And my personal favorite here is the Vanguard Total Stock Market Index Fund, also known as VTSAX. Stocks will act as your core wealth building tool, the engine that will propel your money forward towards the magic of compounding. Number 2 tool is a bond fund. And my personal favorite here is the Vanguard Total Bond Market Index Fund, also known as VBTLX. Bonds will help smooth out the rough rides of stocks, sort of like the brakes that you can tap here and there so you don't run yourself off the road. If you're in your 20s or even your 30s, you don't really need to think about bonds at this stage. This comes more into play later as you get closer to retirement age. Number 3 tool is cash. Cash in my books is one of the most underrated tools because people judge it based on its asset class. Cash doesn't make you much money. It just sits there paying the bills. Thus, people dismiss its power and tend to downplay its importance. However, if you watch any of my other videos, you know I love cash. Not only because it pays the bills, but because it provides so many other benefits like the ability to handle emergencies, to buy opportunities, and my favorite, emotional peace. That's it, guys, the simplest wealth building portfolio in the world. 2 index funds and a checking account. Stocks have become one of the most powerful and successful investments throughout history. And you don't need to look far to see the proof of this power. Just take a look at the S&P 500 the past 100 years, the 500 largest companies in the United States. The trend is up because American companies are working hard to create value for their customers. But you might be asking, why is investing in an index fund the best way to tap into this amazing growth? Shouldn't I just purchase the great companies on my own, buy shares of Apple, Netflix, and Amazon? My answer is no. The more broad your index, the more companies in your portfolio. Yes, American companies as a group are great. They create new products and values. However, to know which specific companies will do well or not do well is almost impossible. Blockbusters was one of the most profitable and popular video stores throughout the 90s and early 2000s. But if any one of us went back to the year 2000, could any of us have honestly been able to guess how and where Blockbusters and Netflix would have ended up today? I think not. None of us have the magic ball to know what company will one day be the next Netflix. Not a problem, because an index fund like the Vanguard Total Stock Market Index Fund automatically recycles fading away companies with new ones. When a company like Blockbusters loses value and goes bankrupt, it automatically gets cleansed from the index. But new companies like Netflix are taking their place. If we were to model all 4,000 companies in VTSAX, we'd find that as some previous big stars like Lehman Brothers faded away, but new companies like Tesla grew, prospered, and took its place. But please note that this only works with broad-based index funds, not actively managed funds. Once fund managers get into the mix, trying to beat the index, this mechanism of self-cleansing goes out the window. Most often, these busy fund managers make things worse by trying to pick winning stocks, which not many can do effectively. And the worst of all is that they charge more to do so. Stick with index funds and gain all the benefits of investing in the market while paying less. Now, let's discuss why you might also want some bonds in your portfolio, especially as you get closer to retirement age, and why a broad bond index fund like the Vanguard Total Bond Market Index Fund, aka VBTLX, is all you need. Bonds' purpose in your portfolio, as I mentioned earlier, is to really help smooth out any bumpy rides in the stock market. When you buy bonds, you're loaning money to a company or government agency. There are also a lot of risks you have to mitigate with holding bonds. For example, default risk. What happens when you loan money to someone, but they decide to default and not pay you back? Or how about interest rate? When the interest rate rises like it is doing right now, bond prices fall. A way to mitigate all these risks while still getting the benefit of holding bonds is to hold broad-based bond indexes like the Vanguard Total Bond Market Index Fund, aka VBTLX. It holds over 10,000 varying bonds such as the US Treasury and mortgage-backed securities of all maturities, short, intermediate, and long-term issues. With this one single bond fund, you get a broad exposure to the US investment-grade bond market. Greater the broad exposure to a diverse set of bonds, lesser the risk. Alright, let's talk briefly about why I'm also talking about cash in this video. And personally, I believe you should hold more than you feel comfortable. The reason is I believe cash provides additional benefits than just covering routine expenses and to meet emergencies. They provide you a cushion for you to think about life in a more broader term. If you have enough cash in your bank account to fund your life for a year, you'll be amazed at the brain space you have to pontificate about the future and strategically make the next move. But when you don't have enough cash, you don't have cushion in your life. And when you don't have enough cushion, you can make irrational decisions. Drowning individuals are probably the most dangerous persons to try to rescue. And like a drowning person, when we're in a financially vulnerable and desperate position, we can't think straight. Thus, the perpetual downward spiral of bad decisions that can put us in a worse and worse financial situation. However, when you have enough cash in your bank account to weather through a year of unemployment or market downturn, you have the time. Time to think, time to plot your next move, and the time to make your best financial decision. Don't see cash sitting in your bank account as just losing value. See it as more than that. Your bodyguard, your fitness trainer, and your thought partner. That is why I consider cash as your third leg to your 2-fund investment strategy. Alright, with that said, let me share some sample portfolio allocation with the 2 index fund by life stage. The first sample portfolio allocation is for the wealth accumulation phase. For many of us, this phase of life is when we're in our 20s and 30s. We still have a long career ahead of us, and withdrawing from a portfolio is still many years away. During this stage, the recommendation is to be 100% in stocks, 100% in VTSAX. Yes, 100% in stocks is considered a very aggressive investment allocation. However, when you're young, you should be. You have decades ahead to invest, and market ups and downs should just be noise to you. You should be excited for market dips during this phase because there are great buying opportunities to scoop up more shares of VTSAX at a lower price. The second sample portfolio allocation is for the transition phase. For many of us, this phase of life is when we're in our 40s and 50s. Retirement is not right around the corner, but you can see it coming. During this phase, I would recommend sprinkling a bit of VBTLX to get used to holding bonds in your portfolio. Maybe start with 5% the first few years, then up it to 10%. You want to start transitioning from a 100% stock heavy portfolio at this stage, so you can get ready for the wealth preservation phase of your life. The third sample portfolio allocation is for the wealth preservation phase. For many of us, this phase of life is when we're in our 50s and 60s plus. We've built our wealth, so now we want to preserve it to fund our lifestyle going forward. This is where you can ramp up the bond holding to 25%. So you're 25% VBTLX and 75% VTSAX. If you're even more wary of volatility, maybe even 30% VBTLX and 70% VTSAX. Or even 40% to 60%. Though for me, this might be too conservative. But who knows, right? When I get to this stage in my life, I might have a very different perspective on risk. That's it, guys. The world's simplest portfolio. 2 index mutual funds and a checking account. If you'd like to learn more from someone much more qualified to talk about this concept, please check out Gerald Collins' The Simple Path to Wealth. It was this book that really inspired me to simplify my investing approach, and I haven't looked back.